Hello everyone and welcome to today's session. I am Avsheen Kaur, Assistant Professor, Management Education and Research Institute. Today we are going to discuss various management terms. Let us discuss with the basics. What is management? As defined by Henry Fayol, management is to manage, is to forecast and plan, to organize, to command, to coordinate and to control. Management is a multifunctional organ that encompasses a wide range of fields including corporate governance, operations, financial management, strategic management, human resource management and several others. So, let us start with our basic terms. Our first term is market capitalization. Market capitalization is the total market value of the company's share. It has been calculated by multiplying number of shares by the each share market value. A company's market capitalization is rupees 50 lakh. If it has 1 lakh shares each having a market price of rupees 50, then its total market value will be 50 lakh. Next term is current liabilities. Short-term debts of a company which are required to be settled within a year are termed as current liability. For example, short-term loans, accounts payable, accumulated expenses, additional debts that should be paid soon are instances of these liabilities. Next term is current assets. Assets that are intended to be converted into the cash in a year or during the course of company's operations is termed as current assets. They have been commonly utilized to evaluate the company's liquidity. These assets are essential for day-to-day operations and liquidity. Examples include cash and cash equivalents, account receivables, inventory, we can also say stock and short-term investments. Our next term is operating expenses. Cost incurred by the business for executing its daily commercial and operational activities. These expenses are necessary to maintain regular business activities including providing services or producing goods. Let us take an example. A bakery spends money on rent, salaries and electricity to keep running its business daily. These are its operating expenses. Our next term is cost of goods sold. Total direct costs associated with manufacturing goods that company sells are referred to as cost of goods sold. Examples include raw materials, manufacturing labor, factory overheads and direct expenses. Let us take an example. If a company manufactures shoes, COGS would include cost of leather, stitching, labor with additional material utilized for making the shoes. Our next term is leverage buyout. A leverage buyout involves another company purchasing a company using a huge portion of borrowed funds to cover acquisition cost. Bonds and loans are instances of the borrowed money. In a leverage buyout, the acquiring company uses the assets of the target company along with its own equity to secure the debt needed for the acquisition. For instance, a business may borrow the funds to acquire the another business and subsequently utilize the assets of acquired company as a collateral. Our next term is burn rate. Startup companies and investors use the burn rate to monitor the monthly cash reserves a company spends to cover its overhead costs before it begins generating the income. It is a measure of rate at which company is burning through its capital reserves. A high burn rate can be risky because it may mean the company will run out of the cash sooner unless it secures additional funding or start generating revenue. A low burn rate suggests the company is conserving its cash, which can be positive sign especially for the startups that need to manage limited resources. Let us take an example. A startup spends $10,000 each month on rent and salaries before it starts earning any money. This is its burn rate. Our next term is dividend discount model. Dividend discount model is a valuation method. employ for determining intrinsic value of these stocks by taking into account current value of anticipated future dividend payments. Let us take an example. Dividend D1, expected dividend of next year is 4 per share. Required rate of return is 8%, or we can say return shareholders expect to earn, and dividend growth rate is 3%. Present value of the stock could be determined by dividing expected dividend by required rate of return minus expected growth rate of dividend. According to this formula, the result is 80. It means the stock should be worth $80 today based on the anticipated future dividends and their growth. Our next term is economic value added. Economic value added is the remaining wealth or residual wealth after deducting the company's cost of capital from operational profit and cash adjusted for tax. For example, over and above the expected rate of return or the cost of capital, a company has the potential to generate 1 million shareholder value. It serves as an indicator of an organization's financial performance by quantifying the value that is generated besides required return on the capital. Our next term is precedent transaction analysis. Precedent transaction analysis values a company by examining comparable acquisitions from the past. For instance, to value a software company, analysts compare recent acquisitions of a similar tech companies. Our next term is multi-period excess earning method. The multi-period excess earning method is a valuation methodology utilized to determine the intangible assets fair value such as goodwill over a specific period of time. For example, imagine a company that sells the products not only because they have a good product but also because they have a loyal customer due to their strong brand. The excess earnings the company makes thanks to its brand and customer loyalty are considered the value of its intangible assets. This method determines the extent of the company's intangible assets contributing to its overall value over the time. Our next term is initial public offering. When a company generates a money by selling its share to the public for the first time on the stock exchange, it is known as initial public offering. For instance, a private tech company raises $50 million on the stock exchange by introducing its shares to the general public for the first time. Our next term is cost of capital. Cost of capital is the minimum rate of return that a company must offer to the investors in compensating for the risk associated with their investment. For example, company needs to earn at least 8% of profit on a project because that's what investors could make elsewhere. Our next term is management buyout. A management buyout occurs when the management of the business borrows the money to purchase the business and buy out the current owners. It is a corporate finance transaction whereby management of an existing business borrows money in order to purchase the business along with buying out the current owners. For example, the managers of a small tech company may decide to purchase the company from its current owner using a combination of their own money and external financing, gaining full control over the business. Our next term is sensitivity analysis. Sensitivity analysis is a financial tool utilized to assess how variations in the key assumptions or the variables that include growth or discount rate impact a company's value. It provides a cause and effect relationship. For instance, a financial analyst predicts profits will drop 20% if the raw material costs rise by 10%. Our next term is overheads. Overheads are the expenses that aren't directly associated with a specific product or the service, including salaries, rent, and insurance. The production process isn't explicitly associated with the overheads that are essential for the business to remain operational. They are usually fixed or semi-variable costs, meaning they remain relatively stable even if the production or the sales get fluctuated. Our next term is minority buyout. A minority buyout occurs when the outside investor or a company purchases a non-controlling portion of the company's stock. This type of buyout involves the acquiring party purchasing less than 50% of the target stock of the company, thereby becoming a minority shareholder. For example, an investor buys a 30% stake in a company, becoming a minority shareholder with a non-controlling power. Our next term is Statement of Changes in Equity. This is a financial document that summarizes the transactions related to the shareholders' equity and explain the changes in the reserves, retained earnings and share capital over a specific period. Our next term is hedging. Hedging is a risk management strategy or a technique in which an investment is made with the intention of minimizing the risk of adverse price movements. Let us take a basic example. A farmer agrees to sell wheat at a fixed price before harvest to avoid losing money if price drops later. Our next term is merger. Merger are corporate strategies involving integration of two or more businesses to establish a single innovative legal entity. It is an agreement between two existing companies to create one unified organization. For example, imagine a company A, large retail chain, merges with the company B, a successful online marketplace. The two companies agree to combine their resources, strengths and customer bases to create a stronger, more competitive business. After the merger, the new company benefits from a broader product range, increased market share and enhanced capabilities. Our next term is joint venture. Joint venture is a strategic partnership involving two or more corporations combining their resources for accomplishing shared objective is termed as joint venture. For example, two tech firms collaborate to create a new software for healthcare management. Our next term is razor blade business model. Razor blade business model is a pricing strategy in which a company sells its base or the primary product at a loss or a low cost with the aim of selling the complementary product at a higher margin or a profit. For example, a company might sell the printer, the base product at a low prices and make a profit on inkjet cartridges, the complementary product. Our next term is freemium model. The term freemium is originated from the combination of two terms, premium and free. Free basic versions of the product are offered by the business model while the advanced features are subject to the charges. For example, Spotify. Spotify uses the freemium model. The basic version of the Spotify is available to the users at no additional cost. This version is characterized by advertisements and restricted capabilities, including the ability to skip the tracks. However, they have the option of upgrading to the premium subscription to enjoy an ad-free experience, increased audio quality and offline listening. This model attracts a large number of users, some of whom eventually convert to paying customers. Our next term is pay-per-use model. Pay-per-use model is a payment model where a customer is charged for using the product rather than buying it outright. The company owns and is responsible for the product and the customers pay only a nominal fee for using the product or the service. For example, Uber uses this model where the passengers pay for each ride based on the distance travelled and the time spent rather than the fixed fare. The more a customer uses the service, the higher the charge will be. Our last term is white labeling. White labeling is when one company buys a product manufactured by another and sells it under its brand name. For example, a grocery store sells coffee made by the another company under its brand name. Thank you for your attention and I hope this overview of management terminologies was helpful to you.